Tell me why.
Ain't nothing but a heartache.
Perks of video editing. What's up, money hearts? Now, if you didn't know that song, you're probably too young to remember the 90s. You know, the era that brought us groups like the Spice Girls and the Backstreet Boys, when phones looked like this, and whenever you connected to the internet, you will hear something like this. The 90s. It was also the era of the Dotcom bubble, which we will be discussing today. What happened? Are we experiencing something similar now? And more importantly, what lessons can we learn from the Dotcom bubble that we can apply today? All these answered in this video. Before we talk about the Dotcom bubble, we need to talk about what the internet was like in the 90s. One of the most commonly used browser was called Netscape Navigator, and this was what it looked like. Now, it may look primitive to us now, but that was the browser that was easiest to use back then. And because it was such a popular browser, Netscape, the company, decided to go for an initial public offering or IPO. Let me spend a little time explaining what an IPO is, because it is important in this video. Let's say I want to open a company called Mickey's Cupcakes. Yeah, I'm kind of hungry now, but that's not important. If I don't sell off my shares, I own 100% of Mickey's Cupcakes. But if I want more money to expand my business, I can offer my shares to the public. A team of lawyers and underwriters will decide what the share price will be initially. That, in a nutshell, is what an IPO is. A company turning from privately owned to publicly owned to raise funds. August 9, 1995. The day Netscape went public, shares were offered at $28 each. It shot up to almost $75 before closing at $58 at the end of the day. So those who managed to buy the shares at the start more than doubled their money in just one day. Many people made double-digit returns on their investments. And this was one of the factors that started the huge demand for Dotcom stocks. By the end of the year, Netscape's share price will rise to $174. This sparked a huge demand for technology stocks. Everyone wanted to buy into Netscape or buy into the next Netscape. This included people who knew nothing about investing. They were investing because they saw how much their friends were making, or even worse, how much people in the news were making. And remember, this was an era that did not have social media. So people then were less exposed to news and stories of how other people are making fantastic returns. So in a way, we are more at risk of investing in something because someone online told us to do it. But back to Netscape, its success sparked a huge wave of internet companies being set up. Adding a .com behind your company became the next in thing, and investors flocked to buy up stocks of internet companies because everyone wanted to buy the next Netscape and make it big. Plus, this was the era of low interest rates, which meant it was easy for people to borrow money and invest. Only have $1,000 to invest, why not borrow another $9,000? If your returns is higher than our interest rate, your returns is magnified. That contributed to many people becoming overnight millionaires through the stock market. Because by borrowing and leveraging, you could make a few $100,000 instead of a few $1,000s. But what many people didn't realize or didn't care about is that by borrowing to invest, your risk is magnified as well. It was essentially using a gambling mindset to invest. It was perfectly okay for people to follow trends, set up internet companies, and go public. What was not okay was the way some of these companies worked. You see, most of these .com companies were operating at losses. They spent heavily on advertising to try and gain market share and gave huge discounts, even at the expense of profit. One of these companies was called Pets.com, which sold pet supplies. During its first financial year, which was 1999, it earned $619,000 in revenue. Pretty good, right? But it spent $11.8 million on advertising alone. Say what? And that's not all. They were selling their popular products at a loss to attract more customers. The goal was to use these popular products to attract more customers and then sell them other products with a higher margin. Except their customers didn't do that and only bought the products that made Pets.com losses. So combine the losses they were making on their popular low-ticket items with their heavy advertising, Pets.com was losing money fast. And yet, in February 2000, when Pets.com went public, it still managed to raise $82.5 million. Its advertising had worked, particularly its advertisement in the Super Bowl in January 2000. It cost Pets.com a whopping $1.2 million, but pushed it to a nationwide audience, which was what they wanted, but from a business point of view, was not sustainable. And there were lots of companies operating the same way, ignoring profits, spending huge on advertising, and trying to gain market share. And one of the most dangerous things about the stock market, be it in the past or now, is that a company's share price is not an indication of how well it's doing financially. Because many people buy with their emotion and not with their logic. Just take a look at GameStop. So the stock market in the 90s was filled with dot-com companies that performed really well in the market. But if you look at the company finances, they were losing money. Lots of it. The owners of these companies had one of two strategies. Number one, sell off their shares of the companies when share prices go up. Or two, gain enough market share, sacrifice current profits, and hope that the money will come in the future. But for most of them, the money never came. One of the main concerns going into the year 2000 was the Y2K bug. You see, back in the 90s, computers displayed their dates in a day-day, month-month, year-year format. Or if you're American, month-month, day-day, year-year format. Which is something I never understood. America. Why? The point is, the year slot only had 2 digits. Because adding the 2 digits in front of the year would mean taking up more computer space. And in those times, it was not efficient. So the main concern was if 1999 turned to 2000, will computers be confused between year 2000 and year 1900 or 1800? This concern over the Y2K bug was one of the reasons the Federal Reserve kept interest rates low. When the economy is not doing well, interest rates will be lowered to encourage people to borrow money. When the economy is doing well, interest rates will be raised because people had more money, so the Federal Reserve could earn more interest from the money they lent. So the 90s was a unique era whereby the economy was doing well and yet interest rates were low. The Y2K bug turned out not to be a problem at all. This was because of good preparation. Many people had anticipated this problem and had a few years to prepare for it. But they weren't prepared for this. With the Y2K bug turning out not to be a problem at all, the Federal Reserve raised interest rates in February 2000. This meant companies who took business loans and were making losses had to pay more interest. People who borrowed to invest paid more interest but were making less returns. And also, Japan, who was the second largest economy in the world back then, went into recession. All these factors combined to create a huge drop in demand for dot-com stocks. Many companies went bankrupt, and many of those who didn't saw more than 50% drop in their share prices. Pets.com went out of business in November 2000, only 9 months after it went public. And And by the end of the year, nearly $2 trillion had been wiped out from the stock market. That's 2 and 12 zeros. It would take around 15 years for the Nasdaq to recover from the drop. By now, some of you would have seen the similarities between the dot-com bubble and what we are experiencing right now. First and foremost, people are investing with a gambling mindset. If you can't picture how often dot-com companies were popping up in the 90s, take a look at how often cryptocurrencies are popping up now. Now, I'm not saying cryptocurrencies are bad. Out of the many dot-com companies that were formed during the dot-com bubble, we have companies like Amazon and Google. Take a look at how they have grown since. And I believe out of the many cryptocurrencies around, there will be some that will prove to be good investments. But too many people are approaching cryptocurrencies with a gambling mindset. They want to find the next currency that will rise 100 times, 200 times in value. If you put a small fraction of your money into cryptocurrencies, that's fine. Take it as buying the lottery. If you win, great, but if you don't, at least it doesn't hurt you. Number 2, following trends instead of learning the skills you need to invest. We are now in an era where information is readily available, but not many of us can filter the right information out. There are so many experts out there who show you their returns and then ask you to follow their advice. In a market that's doing well, it is easy to become an expert. I can invest in 100 different companies or coins, pick the ones that make the highest returns, and then market the hell out of those investments that I made. In the 90s, it was stockbrokers or people who appeared on TV and radio that had the power to influence people. In today's era, anyone can become an expert. All you need is a phone. The best way is to not look for tips. Look for educators, people who teach you how to analyze investments and how they trade. Like what they say, give a man a fish, he will be full for a day. Teach a man to fish and he will be full for a lifetime. Number 3, we have companies that ignore fundamentals and focus on future earnings. We have talked about Pets.com, which was one of many companies that sacrificed too much current profit to gain as much market share as possible. In the modern context, the first company that comes to mind is Tesla. And I know this will ruffle a lot of feathers.
You know nothing about Tesla. You can't gauge Tesla on its fundamentals.
Now, I'm not saying Tesla is a bad company to invest in. I'm saying if other companies operate the same way Tesla does, then they will be in a very dangerous position. But because it's Tesla, its growth and potential can justify the way they operate financially. I mean, it already made so much money from Elon Musk's tweets, right? The point is, you can only rely so much on future earnings. If other companies followed Tesla's business model, like how so many companies followed Netscape in the 90s, then the whole market will be very dangerous. Will Tesla end up like Netscape? Or will Tesla end up like Google or Amazon? We shall see in the upcoming years. Now, there are many other similarities. The low interest rate environment, which I explained earlier, the spike in the number of IPOs, technology stocks being the most profitable, and there are probably many more that I haven't covered. The thing about a bubble is that it can burst anytime. It can last for months, it can even last for years. The important thing to know is the market will not go up forever. So you have to be prepared for the inevitable crash. Make sure you have 6 to 12 months of your expenses set aside for emergency. Shift some of your investments into safer instruments like bonds. You might earn less when the market goes up, but at least you are exposed to less risk. How much to shift really depends on your risk appetite. Take the time to educate yourself about investments. The more you know, the better equipped you will be, and you will depend more on yourself and less on those experts online. And there you have it, the comparisons between the dot-com bubble and the present economy. It's impossible to cover everything in just one video, so use this as just one of your many sources of information. Stay safe, invest safe, and remember to like, comment, and subscribe for more relationships, finance, and investment tips. I mean, it's everybody.
Yeah.
Tell me why I never wanna hear you say I want it that way.
So tell me what you want, what you really want. I'll tell you what you want, what I really want. I really wanna. I really wanna. 6 6 6.